Hello, I'm Shane Vernier.
Hi, I'm Connor Woods.
And I'm Nick Quinn. We are the analyst team here at howtotrade.com, and together we're going to show you everything you need to know about trading the Gartley pattern. So let's get started. The Gartley pattern is one of the Harmonic series of chart patterns, very much reliant on the Fibonacci sequence for its construction. Although originally designed for the stock market, it can be used in other asset classes as well. One of the most commonly traded patterns of all of the Harmonic series. It gives traders a clear sense of price targets and stop loss locations. Plus, traders can use it to forecast both bullish and bearish price action in the Forex markets. So let's take a look at exactly how we'd go by identifying it on a price chart. So this is what a Gartley pattern would look like in the price action. You can see we've got 1, 2, 3, 4 turning points within the pattern itself. We label these A, B, C, and D, and they're all contained within this swing here, which we've got from 0 to A. Now, the way that these harmonics tend to work is that they're very much in tune with Fibonacci ratios, and it's the Fibonacci's that really give us the confirmation that this is the correct way of identifying a Gartley pattern. Now, what we're looking for is within the context of this swing, this is where we would use our Fibonacci retracement tool to span this entire distance. What we're searching for is this point B to connect with our 61.8 Fibonacci retracement level, and that there we're going to just want to draw that in. Now, the point C, that's going to want to connect with the 38.2 Fibonacci retracement, which we'll draw in there. And then finally, our point D, which is our real trigger for confirming that this is a Gartley pattern, that is going to connect with the 78.6% retracement level. And that would draw that in there. Now from here, what you're going to want to do is to look for some reason to be getting long at this 78.6 area. That could be confirmation by a candle pattern that gets built, or maybe some change in momentum using an indicator, but that is the cue to get long. And then we're looking for ultimately to trade back higher above B and ultimately trade back above C, and then ultimately from there take out the swing point here at A. But that is the correct way that we would go about identifying it on a price chart.
Okay, then let's have a look at an example on how we can trade this on the chart. So if I get my drawings back up on the chart, we can see that Gartley pattern forming shape, and this is a bullish example. So we've got our initial move, our initial bull move from Z to A. And if I draw in the Fibonacci retracement levels, we can see that point A to B is that 61.8% retracement. And then we've got point C to D, which is our 78.6%. Now, in theory, what we want to do is we want to place that buy at the 78.6% with a stop loss in theory just below or at the point Z. And then you can see, say for example, we targeted the 38.2%, that would have been nearly a 2-to-1 risk reward trade. But you can actually see this trade went on to yield some more gains here, around 3-to-1. Risk reward trade, which is a fantastic risk reward, and that's exactly how we can trade that on the charts.
Okay, let's look at the pros and cons for the Gartley pattern. On the pros side of the ledger, the pattern occurs frequently. It may be traded in all markets on all time frames, so the Gartley will give you an abundance of trading opportunities. It will also often produce buy and sell signals with exceedingly positive risk versus reward ratios, which is beneficial to any active trader. Now, on the con side, the Gartley can be challenging to identify and construct in the live market. It's a little bit more involved spotting the different phases of the pattern itself. Also, the pattern loses its efficacy in consolidating markets. So when the market flattens out, it can be a very big challenge to trade effectively. And lastly, in many cases, the Gartley pattern produces conflicting signals. So it's not out of the realm of possibilities that the Gartley can give you a buy and a sell signal at the same time. Now, let's review some of the key takeaways from the Gartley pattern. Number one, the Gartley pattern is a harmonic chart pattern. It suggests a continuation of the prevailing bullish or bearish trend. Number two, Gartleys consist of 4 waves, Z to A, A to B, B to C, and C to D. The Z to A wave is an initial bullish or bearish move. A to B is a 61% retracement of Z to A. B to C exceeds the 38% retracement of Z to A. C to D is the 78% retracement of Z to A. Market entry points are subjective but commonly involve the Z to A wave 61% or 78% Fibonacci retracement. Number 4, profit targets are also subjective. Stop losses are placed below or above the Z point. Now, if you want to learn more about the Gartley pattern, be sure to check out the How to Trade Trading Academy inside our trading room. There, you'll find a longer form tutorial where we'll show you exactly how to fit the Gartley into your own trading methodology. We'll then demonstrate how to take that plan and trade it against real market price action. You'll have everything you need to gain valuable market experience, and once you're ready, feel free to join our How to Trade Funded Trader program.